We go. All right,
Okay.
so we are finally here and we are finally getting started, and we'd like to welcome you to our May monthly jobs report, inflation update, and geopolitical chaos roundtable get together. My name is Albert. I'm the founder of Albert's List, and you are here for our monthly webinar where we not only where we stray a little bit from talking about how to land your next job, and we talk about all the factors that are preventing you from possibly getting there. And so, with all the things that are going on, we have brought back, as always, our friend, our partner, and our oracle, Dr. Reilly White of the University of New Mexico. He is a finance professor. He's the associate dean of teaching, and he has a lot of the answers, at least I'd like to think, so that we can figure out what's going on in our job search. So feel free to drop your questions in the webinar chat. We are recording this webinar, and I'll also have a LinkedIn link here shortly so that you can connect with Dr. White as well if you'd like to connect with him between these webinars and maybe even get more insight. So, Dr. White, thank you so much for coming back as usual. Over to you.
Thank you so much, Albert. Thanks, everybody, for being here. It's an honor, as always, to be in front of this incredible crowd here at Albert's List. Thank you for your patience. I'm sorry about the technical delays. I'll figure this out eventually. It's just, it was like a terrible storm. It rains once a year here in the deserts of New Mexico, and it's today. And unfortunately, everything goes haywire that day. We couldn't do anything. The internet at work was down, which is terrible. It was diabolical, everything that went on today. So I apologize. I know it's small and you can't possibly read the fine print in this very, very tiny screen. How to make this a little better. I know there's not much I can do, but I will say I will read it to you as a distant but weird uncle would read to a child they don't know what to do with. So let's talk a little bit about May 2025. So we had a very lukewarm jobs report, and it's not really the story of this jobs report, which comes from the payroll survey. We're going to talk about the household survey, which was in fact notably weak, and we'll talk about that next. We added about 139,000 jobs. Aaron, I would love to download it to PDF, but it's not even letting me use PDFs at this point. I promise you, I am doomed across many different software packages. I just have to restart the computer and let it do its thing, and then it'll figure it out. But I just don't have time. So, 95K in downward revisions in March and April, all bad news. Healthcare, again, up 62,000 this month. Good leisure and hospitality across the country are up 48K. Notable bright spots. However, we're starting to see that trickle down of those federal job cuts here. We have about a 22,000 cut in federal government, as well as about 18,000 in professional and business services being job losses. The interesting parts about this, too, we had a drop in labor force participation. That's the amount of people who could work that are actually in the labor force, either looking for a job or they have a job. And the number of people jobless less than 5 weeks. So these are newer people on the unemployment spectrum, increased by about 264,000. That's a 10% increase. This number has been going up fairly gradually. You can tell everyone to zoom in on the screen and it's sized correctly. Yeah. All right. As Aaron says, zoom in on the screen and it's sized correctly. There we go. Thanks. Thanks, Aaron. Aaron's always full of tons of useful information and numbers, very practical. So this jobs report was kind of where we thought it would be. A little disappointing. We're not seeing terrible and catastrophic numbers, but we are seeing still that trend towards gradual weakening. Now, bringing this down on the other side of this, we've got some other working numbers involving the household survey. And I'll zoom in here for the people in the cheap seats because I think this is worth talking about. So the household survey, there are two big surveys that come out for unemployment. The gold standard is really the payroll survey. We ask companies and firms, hey, how many people did you hire, fire? How many people are employed? The household data comes down to a sample of people, households in the country, and ask them, based upon this, are you employed? Are you underemployed? Are you in the labor? What are you doing? You're looking for a job. And we saw between April and May in this survey a drop of about 625,000 people in the labor force, a participation drop of 0.2, and the number of employed people drop almost 700,000. And that is notable given that we're cruising up there in the 163.5 to almost 164 million employed people in the country. That is not an insignificant drop. And it's interesting to see how these two will align in the next few months if these surveys will continue to, they're not necessarily divergent, they're explaining different things. but I suspect that we'll see kind of a continued change and weakening in the job market still. But we've been saying that for a while. So let's bring up some more tangible points about what this means. Also, as well, we've seen from the Economic Policy Institute, this drop in month-on-month in federal worker employment. We saw the post-Doge cuts are starting to trickle through, and we're seeing that month to month now, and we can see that drop off pretty substantially in 2025 on this graph. So nothing surprising so far. But let's break this down a little bit further and look at something else. Let's look at unemployment, specifically in skilled areas. The realm of Albert's list, the few, the proud, the educated, the technology-oriented, often technology-oriented barrier professionals. And so if you've gotten the sense that the job market's gotten harder for you, you're not crazy. In fact, it has gotten more difficult for you. If we look at first on the bottom left chart, this is unemployment rate by age in the bachelor's, if you have a bachelor's degree. So obviously, if you're young in your early 20s, your unemployment rates do run typically higher, but that has seen a significant increase in the last couple of years. But it's rising if you're 25 to 34 and if you're 35 to 44 as well. So everyone in this vicinity are seeing higher unemployment rates for people with bachelor's degrees. Now, historically, people with bachelor's degrees have very low unemployment rates, around 2% and often less in good times. Now, with youth unemployment, if we look at recent graduates, near and dear to my heart as an associate dean and professor at the university, but job sectors with growing youth unemployment, we've seen them highly concentrated in very information, finance and insurance, professional, scientific, and technical services. Increases in unemployed recent graduates by 127%. In professional, scientific, and technical services, 60% in finance and insurance, 40% in information and manufacturing, 28% in retail trade. An amazing, interesting. And so this is interesting too, Aaron, to your point. You're looking at this change in unemployed recent graduates. Although it looks like there are fewer unemployed arts, entertainment, and recreation, this is such a volatile sector. It is the sub-industry with the highest rate of hiring and the highest rate of firing. And so, yes, the people find jobs, but they often don't keep them. And so even where it seems to look better than other places, it is brutal. And so right now, these numbers are real. And this is what a lot of young graduates are experiencing right now as they enter the marketplace. It is, in fact, a market that is not well adapted right now to accommodate their needs. And so let's bring it this way. Job losses are running higher across the board. Let's do a few things here. I'll do my best to zoom in for the cheap seats here. I know it's written in the smallest possible font. I pride myself on the size and tininess of the fonts that I can describe. So job cuts around the United States. So looking at cuts that we've seen in 2025 so far, we see the numbers are higher, and they're higher relative to most of 2024, but they are not catastrophic as it stands right now. They're trending downward, but they're still at a level which we would consider higher than average. And so in this sort of situation, that is an important thing to watch because it's showing that there is a lot of stress on the market as a whole. If I were to bring this down, I'll grab a little Bloomberg terminal screenshot from earlier. We've got a unemployment permanent job losers, that's the orange chart, versus U.S. continuing jobless claims. And so we look at continuing jobless claims, people that are renewing this unemployment claim. And we've seen that overall, although on the bottom right, we reached a very, very low period post-COVID. Since this time period, we're ticking upward with a noticeable increase in the slope in the last couple months. Now, if this continues, we will expect to see bigger job market effects in the next few months. All of this is a little bit ominous from that perspective. And this is interesting. All right. Aaron says, as the federal government massive cuts arts and recreation industry. Absolutely true. Everything is tied together in this way. Speaking of that, and that's a good intro to the next one, the shape of government job growth. Government employment has now recovered from the pandemic, and we're seeing the rapid growth in 2023. But since 2023 into 2025, what you see right now, this is a Joe Politano chart. He does these wonderful colored charts here, that the federal government job increases have stopped off. They've stopped off quite significant because this is the beginning of 2025. That employment's going down. State government has been holding And a lot of local government has been picking up some of this slack. And so when we think about government employment, we have to think about local, state, as well as national employment in the federal government. And we're seeing that right now, the total people employed in various governments are about as high as they've been, with federal job cuts being offset so far by hiring in local governments, in particular, those excluding education. Albert says, what do those effects look like? Should we expect the other shoe to drop in September? Where are these shoes? How many shoes are we talking about? Has one shoe dropped? Are we tossing shoes out the window? I shoes you. So this is that's actually a good question. So it depends on a few. The short answer, of course, is that it depends, and I'm going to go into a few details about why. So actually, partially to answer that, Albert, I'm going to go into my next slide because a lot depends on. Hey, wait a second, Reilly. Didn't you say that tariffs were bad news bears and we're running into tariffs and we'd see some effects on that and it would be delayed? Yes. And so looking at, I subscribe to a bunch of newsletters. One of them is Bridgewater. They do a bunch of things and they break down a bunch of things. I share their general viewpoint that tariffs are going to continue to affect the US economy, but we're at the tip of the iceberg right now for a few reasons. But the tariff shock itself is delayed, but not exactly diffused. So effects on things like tariffs lag. And this lags due to things like inventory buffers and supply chain timing and a lot of front-loaded demand. When President Trump announced tariffs some months back, a lot of companies responded by buying a lot of inventory up front. They spent a lot of money buying international inventory, and then they can use that for various parts of production along the line. But as these prices are now coming back into the system, we expect that once the inventory is used, then they'll have to buy more goods at higher prices. Costs are actually right now building across the supply chain. Inventory levels are tightening now. It's been a couple months. Businesses are soon going to be able to pass these prices on to consumers. And pre-tariff import prices are actually rising again, and input cost pressures are going. We can point to Fed surveys about that, PMIs, other things that have given us good information on this. But the Fed stance right now is watchful but unmoved. And Powell called the impact transitory, but the economy is operating still at near capacity. Inflation is trending towards the pre-tariff target. And most Federal Open Market Committee members favor holding rates until tariff effects are fully realized. And so those Fed cuts that we had anticipated last year to help jumpstart the economy, they're being delayed. And as a consequence, that has big effects on business decisions down the line. So the one interest rate that the Fed controls is overnight lending to big banks. That's called the discount rate. It has a ripple effect on all those other effects in the system, though, doesn't it? And so as a consequence, when the Fed lowers rates, that makes capital cheaper, and that's passed on to a bunch of different elements, and it makes building stuff cheaper, it makes planning cheaper, it makes anything involving cost control cheaper. And when they raise rates to combat inflation, it makes that more expensive and reduces the monetary supply. So people have been kind of ogling for the Fed to say, wait a second, I really want you to cut rates right now because a lot of businesses in the holding patterns, waiting for opportunities to invest and reallocate capital, could do so, knowing that they're backed by a more friendlier market. So we've got tariff revenues that are right now. The good news so far is that, yes, we are collecting on tariff revenues. Importers have begun paying the cost of tariffs. We can see that in this chart at the upper left. But when we look at real retail sales, despite some reversal in what we call pulled forward demand, spending across most goods, in fact, remains pretty resilient so far. And that's good because a lot of those prices haven't been passed on to consumers yet. But while there's been progress on disinflation, tariffs are likely going to add some price pressure going forward. And that's why the Fed doesn't want to move yet. And lastly, the inventory to sales ratio, where the inventory is looking at right now. And we saw a surge in inventories at the beginning of the year as companies stocked up on things before the tariffs. These inventories are starting to be depleted. And as a consequence, that'll have to buy more inventory overseas or from wherever. And those costs will be passed down to consumers. So this is good. Are we seeing stagflation yet, said Albert? No, we're not seeing stagflation yet. We're still growing. GDP growth is okay. I'm going to break down a few elements like this. These are some experimental slides that also overlap with the presentation I'm giving tomorrow. So if you got you guys are my project. We'll see if we can make this work. And Melanie says, didn't the Swiss bank lower rates to zero. Oh, yes, did the Swiss bank lower rates to zero this week? So this is interesting. And Melanie, to your point, if I was any country but the United States right now in a position like this and looking at a weakening job market, I would be more aggressive about reducing rates. But because of the United States' unique positioning in the last few months on sort of a trade war, us versus everybody in the world sort of thing, that's complicated that. And that's fundamentally derailed the Fed's original plan of actually cutting our rates further. And so you're seeing, I would say, I would look globally uh, to a tendency not only in Switzerland, who, to your point, did cut rates to zero this week, but other countries around the world are likely going to be reducing rates. Now, back into the question of the dollar that someone had asked about this too. And so currency movements are very strange things, right? And so capital flows to places that are safe. Capital flows to places where the rule of law is safe and things and volatility are understood. Money flows to places and demand for the dollar goes up and down, depending on a lot of different factors at once. So in international finance, there are some competing theories around this and some competing things and competing pressures on this. One, in its most basic form, if all things are equal and a country drops its interest rate to zero, and it's equally risky as the United States, which maintains interest rates that are relatively high, I would move my money into the United States, increasing demand for dollars because I get a higher return on that money. I get a higher interest rate on that money. But it doesn't always work out that way, right? Because we know that higher interest rates often indicate a adverse economic situation or something that we're trying to control. And as a consequence, the real purchasing power might go down. And at the beginning of this post-COVID, and among other things, we had a flush with cash. We had a lot of demand for dollars. And even at the beginning of the rate hiking cycle, the demand for dollars went sky high, essentially right before this year, where the dollar demand was very high. And I think we're still going to see this battle between understanding the breadth and depth of American uncertainty as it pertains to the global markets. But still, people are going to maintain. So the dollar is likely going to continue to face these weakening pressures. But at the same time, a lot of countries will be responding in ways that they're reducing their rates and creating disincentives for people to park their money there instead of the United States. So I don't see a catastrophic drop in the dollar anytime. I just see these things battling it out for some time to come, which is an interesting thing to observe. Now, this is interesting too. So let's talk about home builders. You know who's bummed out these days? Home builders. Why? 7% interest rates, a flush of inventory of housing, a drop off of new construction across the board. Home builders have very little incentive to build when mortgage rates are 7%. And so we look across the board at builder confidence. Are you confident, builders? Can you build me a home? And they go, no, I can't. Builder confidence is low. Sales are low. The traffic of prospective buyers is low. It's 2 a.m. in Kettleman City. That's what traffic looks like. And the next 6 months, and looking at the next 6 months in builder confidence, there's not even a light on the horizon. So all this in place means, although the United States does have a dire need to build housing in different ways that helps take this price pressure off for affordability, we are very disincentivized to do so at this time. But even as this is happening, home price growth is slowing, but prices are still at record highs in May across the country. So there's a median home price just cruising up there at high levels, even though we're dealing with these 7% interest rates. But it is likely that because of certain aspects of the real estate market, because we're putting more houses on the market right now, and there's more sellers out there than there are buyers for the first time in a little bit of time, we're going to see some greater price adjustments in the next year or two. And indeed, Zillow had come out, as we said last month, rather, that we have a prediction in the next year that across the country, real estate prices will be very close to potentially losing a little bit, which is a relatively rare occurrence in housing. So Albert says, someone asked in the question, is it a buyer's market now with more homes on the market? That's the fun part. So yes, in short, it is much more of a buyer's market than it was a year or 2 years ago, but it depends highly on the market and the country that you're in. So take these two pieces of information separately. On the left, 1/3 of baby boomers say they'll never sell. Take it, pry my home out of my cold hands. dead hands. I didn't even say dead. I was worried about saying cold dead hands, but then I'm like, well, cold hands doesn't make any sense. So cold dead hands. So share of U.S. homeowners by generation. See, Jochen, I'm really appealing to that very subtle Germanic humor here. So 1/3 of baby boomers say they'll never sell. And if you look at never, never is a big word. A silent generation owner about 45%, boomer owner about 34%, but even 25% of Gen X and about 21% of millennials say this. That all being said, there's about 500,000 more sellers than buyers on the market right now. And so this is going to continually make this more of a buyer's market where people will have a listing and it will likely sell for a lower cost. In more metropolitan areas are going to see this in the next year, where where the sellers will have to issue price cuts and that level of competition that we've seen just isn't there anymore. And so people are so hesitant about selling at a loss, we're not going to see huge turnover in real estate, but this will help reduce some of those price pressures. And that's good for the market right now, given the increases we've seen. Although bad in general, if you're a real estate speculator and you've gotten a whole bunch of information on it, I understand. But it's good for potential buyers looking in this market because that pressure is at least going in the right direction. Now let's talk about the Fed for a second here. Discount rates are still expected to fall, but here's the deal slowly. And so what this is a dot plot. So this takes all the Federal Open Market Committee members, their projections for the last Fed meeting on June 18th about where the year-end federal funds target rate is going to be. And so we're asking the people who help make this ultimate decision where their target rate is going to be. So the further out you go, typically the greater the dispersion, right? And if we looked at this a year or 2 years ago, we saw a much steeper decline in rates. On the left-hand side, the bottom of this axis is about 2.5%. This is overnight lending to large banks. This is the discount rate. And at the top, it's 4.5%. And this is 2025, 2026, 2027, and 2028, or longer term in general. And so what we've seen is that right now, an expectation, even for the end of 2025, is very close to where we are right now. By 2026, maybe another 0.5% drop, maybe another 1/4 to 0.5% drop after that. And that is very disappointing when the market was expecting at least an order of magnitude higher than that of rate cuts. And so what this means is that these higher rates are here for longer, and that's okay. But we have to adjust to this as a market. And it is, I think, in part, one of the things that there is a lot of uncertainty about, given the sort of circumstances we've seen lately involving, just the tug of war between inflation expectations around higher tariffs and that general weakening job market, which suggests that it's time to lower rates. And so they're easing on the side of lowering, but to the point earlier, they're not moving until we know the true effects of tariffs right now. And that's sort of the big deal. Now let's talk about debt. Interest expenses for government debt are indeed rising. And so here's another fun chart for you as well, looking at interest expense in terms of the amount that we spend on bonds. So relevant to note. So each year when we spend more money than we have to raise that money somehow. And we do so by issuing bonds. And you and me buy bonds in our 401ks, as well as other countries and other institutions and all these other investors do. So we probably hold bonds. We probably all hold bonds in some type of retirement plan. And so the government has this big source they sell to everybody around, and there's never really an issue. Now, if there is a lot of demand for bonds, that means the government can get by charging a really low interest rate on those bonds. And if nobody wants to buy U.S. bonds, the government has to provide a larger interest rate on those bonds to get people to buy them. And so right now, debt interest has now become the second largest U.S. government outlay category. And it is still, it's cruising around the low double digits, 10 to 12% level. But it's very significant. And this is due not only to our aggregate debt burden, which is significant, but the higher interest rates that we're paying on that debt. And so this is challenging because that's money that could be used to spend on other things that we are paying to finance our government debt. And so while the spirit of cuts are I think, correct in the sense that they're trying to reduce that cost. The nature of how we reduce those costs really need to be addressed because this ultimately 10 years, 20 years, 30 years can't be sustainable at this level. But it's a very complex calculus about how to make this more efficient. Now, on this level too, we've had some recent geopolitical events in the Middle East, and people are often asking, and they say, "What will this do to oil prices? What about the oil?" Speaking of Kettleman City, but we're just going to rock and roll this. So how do we determine oil prices in the United States? What is the oracle by which this is determined? So there's two big ways we calculate oil prices. One is something called the West Texas Intermediate Price, and that is decided in magnificent Cushing, Oklahoma, where we actually had a finance conference once in Oklahoma, and we had a field trip to Cushing to see how the oil spot prices were made. And the spot price of oil is often how we describe oil prices in the United States. And right now, and the other way overseas, often they use Brent, which is another metric, another market for calculating prices. And oil is a global commodity. It swishes around, goes everywhere. People buy it, all the things. There are pipelines. It's big business. So the oil spot price, incidentally, despite the Middle Eastern turmoil as so far, it just kind of oil prices kind of went up just a tad, just a wee bit, just just like a few snowflakes, a few bits of whimsy higher than it was before. And we know over time, oil prices have a tendency to be highly volatile. And this is a chart since 1985 that shows how oil prices can often skyrocket based on demand and global crises, and then often they go down in recessions because of reduced demand. Now, what's helped the United States around this level in particular, and our perception of oil prices, has been that our production has gone up drastically in the last 15 years. So oil production in the United States, which reached its previous peak around 1970 at about 10 million barrels a day, fell until 2010. And then through advances in technologies, in particular fracking and other things, we've now increased our oil production almost about 2.5-fold since that time period. And the United States now is the biggest oil producer in the world, in fact, bigger than Saudi Arabia. Now, we know that Saudi Arabia, Russia, Venezuela, Kuwait, Brazil, these countries are part of OPEC. And OPEC was very powerful in the 1970s, of course, because the United States, being an oil guzzling country, was highly reliant on foreign imports of oil. And as a consequence, OPEC was able to leverage that effectively from a policy standpoint with the United States. But since the United States has become more of a producer in this sense, it makes a much lower effect. And even among OPEC nations like Iran, there's big differentiation into their level of respect and influence over the organization. And so we're not anticipating any drastic price increases, even though we're dealing with a potential significant Middle Eastern conflict, depending as so far. But it's a very interesting take. Now, next on this one, let's talk a little bit about this as well. This is another question that had come up previously from other things. We've got a changed immigration policy and immigrants in general. So looking at a few things about this too, there's some looking at economic papers solely on the question of immigration. Immigration is usually a sign of a vibrant and strong economy. Immigration in aggregate, and this is not looking at the question of documented or undocumented, but the mere question of immigration. Immigrants often have are proven to have a higher level of entrepreneurship, and they're able to adapt and become often very effective business owners in a very short amount of time. And they become economic movers and shakers in various capacities. But on the undocumented immigrant side, the question is what is the impact in California of undocumented immigrants? And right now, say if you look at something in the Bay Area, immigrants as a percent of population, that's about 33%, about 1/3. And undocumented immigrants are about 6.4% of the population, or about 19% of the total immigrant population in the Bay Area. And that's significant. In particular, they're concentrated in a few industries, particularly in construction, about 16%, agriculture, accommodations, other services, transportation, and retail trade. All of these are where this labor cost is. And in California alone, it's estimated they supply about 70 billion in aggregate wages, about 10 billion in state and local taxes, 12 billion in federal taxes, and about 47 billion in spending power. So especially if you're looking at the question of is the impact of this strong, is it weak? One of the things to consider about this is that, well, immigration in general, including undocumented immigrants, do have significant economic impacts on a state. We know that there are the positive impacts are they increase the vibrancy of an economy, increase growth rates, other things. They also put pressure on things like housing prices and other things as well across the world. And that's partially due to the fact that we can't build as fast as we can in certain aspects. And that's something that's really an Anglophone experience regarding this, and that other countries have been more successful at accommodating immigrant growth. But this is being said is that I would expect that one unknown around this is whether or not how big this impact will be, depending on this, and it will be sizable. There will be billions of dollars of economic impact to the question of immigration, regardless of whether how you support or don't support different pathways of undocumented immigrants into citizenship. They are here and they're spending money, and that does benefit the economy in aggregate. So if we extend this a few things, though, Albert says, will Powell be late, as Trump keeps saying? That's an interesting question. So is Powell going to be too late in action-wise? Trump is putting a lot of pressure on Powell to lower rates right now and incentivize economic growth. And that's for good reason. I mean, it seems I fundamentally I suspect even Trump is aware of the negative economic repercussions of things like tariffs, and having at least a counterbalance to the tariff regime with lower rates would help economic prospects. But right now, that's not the case, and Powell's focus is on the dual mandate, maximizing employment as well as keeping inflation around 2%. And by putting upward pressure on inflation, you're asking him to fundamentally ignore those facts. So right now, I think Powell is actually being very prudent, in fact, in ignoring these pressures and being autonomous in his pressure. I actually respect that positioning. Albert says, since many of them work in these fields, have we measured how their deportations impact the price of produce? It will, and that's the hard part, because some of these, I mean, the question is fundamentally, and it's also accommodation and all these prices. This all comes down to, where's the availability of workers, and do we have that? And especially if you're looking in the San Joaquin Valley, for instance, where you have a large amount of agricultural labor that is often, or at least partially undocumented. It is a huge portion of this. And it's a huge portion of the calculus for prices and a huge portion of everything else. So I suspect that if you remove tomorrow all these undocumented immigrants, the price effects would be substantial. And so the nature is how effective or what's going to happen and how will it be. But it will impact the price of produce. Absolutely. 100%. All of these industries, construction costs as well. Absolutely. Now let's break down. We've talked a lot about bad things in the economy. So I pulled some charts over from the Federal Reserve Bank of San Francisco. Daniel Wilson has a great blog that's actually worth looking into. And credit to Shane Boyle, who also works there and generates these charts. So economic fundamentals are weakening, but they actually still remain strong. So payroll employment remains solid. So employment growth, if we look at official BLS data, we're still at the end of the day improving on jobs, and that's still good. The 6-month moving average is trending downward, but we're still doing okay. GDP growth at the core level is actually, we're still cooking, and that's good. But the problem is that's right now everyone is focused, right? And so why are people so negative about the economy? Sentient measures right now are terrible. So even though the economy might be doing superficially well on the surface, people feel like it's not, for good reasons. They've fallen sharply. Even in May, look across the board. The beige book sentiment from the Fed, the least exciting color of a book, has dropped drastically in May. The Daily News sentiment is down. And the University of Michigan Consumer Survey, the gold crucible on which all sentiment surveys are themselves forged, have dropped drastically into the negative territory. Household inflation expectations have also spiked. So when people say, is inflation going to go up? And maybe I'm the problem. Maybe it's all of us pop economists out there rocking and rolling and explaining these things. But the truth is, at the end of the day, people's expectations are bad. So how do we relegate this? And why are the expectations bad? And this comes down to the policy uncertainty that we've done. As it turns out, as you might be surprised to know, economic policy uncertainty has indeed gone up. What are we doing? Where are we doing with this? Do we have a plan? What's going on? And if we look at a survey of professional forecasters, the Federal Reserve Bank of Philadelphia runs this thing called an anxious index. And the anxiety of our recession risk has gone up substantially in the last couple of quarters. And we're now arguing that we've been hovering between this 30 and 50% level of will a recession happen or not. So Albert says, what do you have here? And if we paid minimum wage for these types of jobs to legal citizens, how much would that also impact the price of produce or food? You're absolutely right. Effectively, Albert, to your point on this, undocumented workers do in fact subsidize the price of food in this way. And so it is very hard to find labor of any kind to do this type of agricultural work. It is a fundamental issue. Many agricultural produce, for instance, does require some type of hand collection. Here in New Mexico, we have our famous chili peppers, right? We've got red and green chilies. And so they rely almost exclusively on immigrant labor to help harvest these. It is terribly hard work because you're engaging, you look at something as you have to remove it. The way you remove it from the plant is tedious and after a while calloused and painful. And so you need people who are willing to endure that level of challenge. Michael Lyon says, I've always wondered how the undocumented contribute to tax income without becoming an SS number. A good point. And so these things are so you can, as it turns out, there's all these different ways. And so that's actually a very fair question. So if we look at these economic impact calculations, which are derived from, and I don't know to what extent, the Bay Area Council Economic Institute does a lot of things. They used to do a jobs report as well. And when you think about the economic impacts, they have a series of different reports that they run that are pretty good. So there is, in short, many ways that illegal aliens or undocumented workers pay taxes. And I'm trying to bring up a specific example for you here. The interesting part is, or the fascinating part of US law is that it is, of course, a crime to shirk on taxes. And that's how, of course, we look at Al Capone or somebody else, how you get gangsters, right? In those sense, is that, yes, you can get them for being gangsters, but you can really get them for not paying taxes. So, if employers or payers choose to hire legal aliens, the payments to those aliens are subject to the same tax withholding and reporting obligations that apply to other classes of aliens. And so firms are actually thereby required to withhold in that same capacity to be in compliance with the law, Michael. So Albert says, I'm not sure if you got my email about the Albert's List Job Seeker Sentiment Index. We also saw job market negativity. Albert, yes, I'm sorry. I was overseas last week. I took my son to Italy and Spain where I had a conference. And so it was blasting. So I didn't get time to get back to your email. Thank you, Albert. I'm sorry. But we also saw job market negativity well ahead of Liberation Day 2 when compared against deterioration of the sentiments report. And our same index has shown a faster rebound. I think you're onto something on this. I have to refine that. I'll take another good look at that too, Albert. So that's great. So we've got economic policy uncertainty is up, and then recession risk up. People are anxious. But what's the story of hope? And I'm going to give you a reason I'll give you a story of hope. I'll give you a reason for no hope. This is what we do here. We just bat you around like a kitten. So firms are like a kitten playing with a ball of string. So the firms of reference, the Bay Area has 73 Fortune 1000 companies. 73. That's 7%. You are batting so high above your average. And here's where they're located. They're heavily over the few in San Francisco. Look at San Jose, rocking and rolling. Look at the whole Silicon Valley, just making things happen. And even occasionally, I guess, maybe that one firm in Santa Rosa, we can give them that. Unemployment rates are 3.6% around the Bay Area in general. In San Francisco County, it's 3.6%. Office vacancy rates are a concern, but story of hope. 35.4% vacancy rate is amazingly high. Unoccupied office space in San Francisco. But story of hope, when KPMG surveyed business leaders around San Francisco and asked what your top workforce challenges were, employee engagement was the biggest one, followed by upskilling and then recruiting and retaining talent. And 88% said the San Francisco talent pool is superior to other regions across the United States. So pat yourselves on the back. Even if you're looking for a job right now, you're unemployed in the most competitive market in the country. So that's great. When push comes to shove, I know that's the least affirming thing in the world. Albert says, I am curious to know position for growth in what areas, given how pricey it is to live here. I know Google has been outsourcing general jobs to Mexico. I think software strategists, product managers win. But this is the fun part. Position for growth because the people who own companies say they like, generally speaking, they're happy with it. And we can pick chili peppers better than any, says Melanie. I don't know about that. You just come out to New Mexico and work minimum wage jobs. I'm actually working on a report right now about I don't know how this will pan out, but I was tasked for a municipality to create a speaking of jobs, a alternative minimum wage increased framework, which will be pretty cool, which is kind of fun from a policy standpoint. So I'm going to do some index tying and try to create a workable policy framework around sort of a non-traditional way to increase minimum wages. So we're working on it. Stay tuned. It'll be fun. It'll be one of those things that make or break you as a human being. White et al. Indeed. Can we read it on a lazy Sunday morning? The laziest of Sunday mornings. I'm not paying you, as I said. Foul Bay. The job market continues, though, to be challenging. So, yes. So you asked, why are you positioned for growth? Firms are confident about investing. They're happy living there, and they feel like you're coming from the San Francisco talent pool. They are here and located here because talented people live and work here and everything they need. And that's true. That is going to continue to power this. But as you point out to everything before, people are outsourcing, and especially if you're a startup person, you're looking for something like, let's say you have a very reasonable American dream of applying and getting a house of your own. Very hard to do in San Francisco, and real estate prices are upwards of $1 million. So employment on non-farm payrolls in San Francisco has been terrible in the last 12 months. And bringing back the U.S. Bureau of Labor Statistics report, it's time to dig this one up again. And we can see since April 2022, when we saw those brilliant 6 or 7% post-COVID growth rates, we have been in negative territory since April 23. For changes in employment. And across the board, if we look at just April 2024 to April 2025, we're looking at 7% fewer manufacturing jobs, 3% fewer information jobs, and education, leisure and hospitality, and professional business services also down. Education and health services is a bright spot, as well as the government, but that is about it, is what we're seeing. And you're looking at this too, and so hold on, Albert, one thing. So the high cost of living in the Bay Area is not a detractor. Of course it's a detractor. You'd be kicking butt in the universe if you figured out how to build more property. And that's an issue too. And fundamentally at this level, I'm coming from the position of it's not the end of the world. I'm not saying that San Francisco is the city on the hill. Oh no, yes, you're a city on many hills, but there are so many things that need to improve in terms of quality of life. And that need to happen. And I reckon with that actually I didn't include that slide in my Albert's list slide, but I talked about that in the other presentation I developed for tomorrow. So I left that out of this one. Maybe I should put it in. So this parallels with firms moving. Albert says to lower tax states, but also people who've moved to those states like Texas coming back. I've seen articles about how Austin is over. So this is tricky too. So Austin built out a lot of houses. The house prices are declining in Austin now. Hooray. But at the same time, people look at this, and this is the really hard part. San Francisco shoots itself in the foot every time. I mean, the question about fundamentally, it's not San Francisco's fault it's this way. I mean, across the United States, there's zoning and issues and regulations and parking minimums and things that have screwed up the way that we build cities for decades. And so it just happens to be reaping a lot of consequences in this level because there's such a high demand to live there. And because of that, San Francisco is always going to have a high demand to live there. But what needs to happen, though, is some serious considerations about land use. And I know the state of California has done some very proactive things to encourage this, but then there are other laws and regulations that are being abused in this category to prevent the building that needs to happen from actually happening. And so I suspect, in the same way that we got into this mess from 100 years of poor urban planning, I suspect 100 years of careful urban planning can get us out of it. But it's going to take a very long time, and it's going to be very subtle in the way that happened. And that's not going to provide an immediate relief. But I think that demand will continue to be high to live in places like San Francisco because of the strength of its labor pool. But the point is to not be, and I guess I make this point there. I should have included that slide in thinking of this, and I was giving it tomorrow. I'm like, the moral of the story is you can't be stationary. You can't be you have to be proactive about improving aspects of the city that have declined. So in the area, Aaron says Powell will hold rates as he's finishing off COVID Biden inflation and tries to crush the first half of Trump tariff inflation. I agree fully as to Aaron. I think rates are higher longer, and that's as good a reason as any to do it that way. Now, when we think about this as all, and one thing to look at this, and I'm trying to, because I know we've got a very strong negative narrative about the economy and everything, and looking at the Bay Area in general, and you've seen the articles that have come out lately and says, oh, the Bay Area, it's been boom bust since 1849, and that's not wrong. But there's some things that we can think about that are a little bit more nuanced in that about the Bay Area. We know that unemployment typically, in good times, it is even better in the Bay Area. So from the 90s to the 2000s, unemployment was lower. Unemployment in San Francisco, Oakland, Hayward is blue. Across the country, it's this green dot. So the green dots are higher. The unemployment rate is higher in the United States. The job market was so much stronger, even in the good times in the Bay Area, than it was in the rest of the country. But then you have recessions, and the way that the Bay Area behaves in recessions is interesting. So I, looking at the data, I had some theses into this, and this confirmed a few of them, but it was a bit more nuanced than I thought it would be. And so, yes, it is true that if we go back to the history of the last four recessions, that although the tech sector is often very affected by economic changes, when there is a recession, like the one that happened, say, in the early 90s that set off higher rates of unemployment rates, unemployment went up. And it went up in the country more than it went up in San Francisco. But the recovery, even as we approach that very tech-heavy 90s era, was slow. In the rest of the country, it chugged forward quicker, and in the Bay Area, it was sort of like a delay of a hill in that sense. And it was like you shifted the axis of way the Bay Area employment was relative to the country. So as the country increases unemployment and as we go through another economic cycle, the important thing is to realize that even if we're not in a position right now, we're still very much in the downward trend kind of situation. But when we are on the other side of that hill, when we get evidence that, say, general consumer spending is rising reliably and retail sales are up reliably. And I think that the consumer debt burden has shifted in a different way. That won't necessarily immediately indicate a period of growth for the Bay Area, but it will kick in later on. And so while it is a delay, I would expect that the cycles will continue to be this way for some time. I think you're going to go through another development cycle. I think that if we continue to deteriorate and the Fed reduces rates, and whether it's a recession or not a recession, I think when we reach a position of growth again, then the Bay Area will continue to grow, but we'll see what happens. Albert says the question is, how do we get to the other side? And when that other side is going to happen? Because it seems like we've been declining for a while, but we're coming off a COVID high and we're seeing deterioration, but it's not at the level that matters. The good news is, though, nothing is catastrophic right now. And that's something that's I think better news than it seems to be. Now, last but not least, we're looking at the individual, really tough to read for those people in the cheap seats, I know, with the tiny screens. San Francisco, Oakland, Fremont on the left, San Jose, Sunnyvale, Santa Clara on the right. Looking at the individual economic situation, unemployment in both areas dropped to 3.9% in April from March, which was encouraging, but we also saw primarily driven by a drop in the labor force itself. So the San Francisco area labor force dropped about 20,000 and about 6,000 in San Jose. So that's not overall necessarily a good thing. We saw some upticks in construction, which is encouraging, but we're still tracking below where we were last year. Again, we have to go back to those few areas like education and health, where we're still above where we were last year. But overall, if we look at things like the information sector, shedding another 1,600 jobs in San Francisco and 400 jobs in San Jose. And this is going to continue likely for some time, but it will not continue forever. And so down at the bottom end of this, and so what am I missing? So what do we got for questions and other things? I tried to get you guys, it was a hurry up offense type of presentation. Thank you for sitting through it. What do we got? What questions? Melanie says, whatever happened to the mass retirement of the boomers trope? Where are the boomers? They're still working. They're working here. They're taking jobs. Where are these jobs, and are they going to be passed on to other people? And this is an interesting question, Melanie, actually, because there's a few angles to this as well. One is that when we see things like technological advancement or development or AI, when we see that growth rate, when companies don't fire 20,000 people because of technological development A. what they do is they don't rehire in a recession or based on retirements. And so a lot of companies are doing the two things that are happening. One is that boomers are working for longer, which is happening. The second thing is that when they are retiring, a lot of those jobs aren't being filled the same way, and they're perceived as various cost-cutting measures. I know, and we've done the same thing at the university as well. And so often retirements become a way for cost savings that are less offensive. And so in this particular market, we're looking at that as well. Michael says, I'm guessing because healthcare and hospitality are such large categories that a few roles within each of these sectors are increasing, but many more are declining. Michael, that's a great question. I have a specific slide. Oh man, it's almost like I should have just given my other presentation to this group. So I ran a deep dive on healthcare about 2 months ago, Michael. I don't know if I was there last month, 2 months ago, something like that. And I kind of did a few things on this. So healthcare is a very good point. So Michael, to answer your question, we're seeing a lot of activity when we call it healthcare and hospitality. Often these are employment on the lower wage side of this rather than the higher wage side of this. It's everything from billing and encouraging these factors and building up the infrastructure behind the scenes. It's administrative. It's all of this stuff that goes into this. Often the roles that are often most patient facing otherwise aren't really seeing that level of growth. And to your point as well, Michael, the hospitality sector is variegated depending on the type of hospital you are. You've got hospitals, you've got a minority of hospitals that are very profitable, like 10 to 15% profitability rates, and then level net profit rates, I should say. You've got this middle tier hospitals that are barely profitable and a slew of hospitals that are simultaneously losing money. And so efficiency is all over the place and boards all over the place, depending on the market and sector they're operating in. And to your point, hospitals are highly variable depending on the nature of their practices, the specialties that reside within them, and their level of expertise in the market that they operate in. And so all these things it does paint a very wide brush over a very, very diverse sector. And I love that you asked that because it reminded me that I should include that again. So Jokin's got some good Albert questions there. Wow. Look at that. This is fun news. Talking about our electricity bills worse in Austin than in other places. Fascinating. Fascinating stuff, actually. This is really good.
So I think with everything going on, I think the reason why we all keep talking about the shoe waiting to drop is because we've heard a recession is coming for the last 3 years, and a
Who said?
recession is not quite here. Yet, if you also look, I think, at certain parts of like YouTube, people will have you believe that we've been in a depression since like the end of the Great Recession.
Yes.
So like, I guess the question is like, what is it? Um, and
Hmm.
are we seeing the last days of late stage capitalism, all while I watch, New York City mayoral primary results come in and supposedly the socialist candidate is up by 9% right now.
I know.
So it's like, okay.
It's interesting.
Yeah.
Wow. So a lot to unpack with that question, Albert. Okay. Okay. So
Yeah.
break it. All right. So I know there's a
I
lot
mean,
of
right, it's not to interrupt you, but like
like
it's right up there
I,
with the question I want to do explore next month, which is the state of men and whether it's as bad as, the culture seems to say it is, right? So,
yes, that's a good question too. I will tread around those questions reasonably. This is good. So
oh,
first of all, recession, yay or nay, right? And the reason that we're all on this fence is the nature of how these impacts work, and the nature and magnitude of these impacts are known. So I know the economic effects of tariffs are bad. I know that tariffs individually are unlikely to create a recession in themselves, but a reduction in consumer confidence will. So there it is. Now, on the other side of this, we look at this as well. And there's a few things that that I want to kind of elucidate in this sector. So a recession still is very possible right now, but we don't have, so fundamentally there is there's a tale of two economies right now, and we've talked about this before. There is the upper echelon, I would say primarily the top 10% of income, the income distribution is powering economic spending right now in very meaningful ways. We have the bottom half of the economy, which has shown, higher debt levels and all these other things that are indicative of enduring financial stress and being pulled back meaningfully. And this difference is creating vastly different experiences within this paradigm of the economy. And so we can't just paint a brush and say this is this or that. So recession will be possible, and a recession, if we define it in different ways. I mean, NEBR does this, the National Bureau, and BER, National Bureau of Economic Research, defines a recession ex post. It's based on not just two negative quarters together, but a bunch and slew of economic data that's bad. Right now, we are putting down, if consumers were to adjust their habits slightly, cut back meaningfully because of sentiment, we'd likely see a recession in the next year. And the uncertainty lies right now based on conflicting information. We've got sentiment that's some of the worst that we've seen in some time, but we've got consumers saying sentiment is bad, but then they still spend money. So yes, yeah, bad economy, but I'm still spending money. We're not seeing people put their feelings where their mouth is, or they're putting their actions where, so to speak, where their words are, and matching words with actions. I'm sorry, it's been a long day. I can't even tell. Nothing makes sense. So matching their words with their actions just isn't happening. And so then, so that's another thing. And you talk about this other thing. So we don't know yet how consumers will react. I suspect the combination of a snowball of different things could force us in a negative economic space. But there's so much economic uncertainty that it's hard to gauge the magnitude of how these effects will affect the economy. The second issue is you talk about late stage capitalism in that sense. This is an interesting thing. Capitalism has many good things about it, which are very important that people forget, because when they point out failures to capitalism, it's often because capitalism isn't there. So capitalism is something that to exist meaningfully, in its most fundamental level, is about competition, right? It's about having a lot of suppliers and a lot of people who demand goods and want to purchase them. And where we see failures in this is that capitalism can tend towards oligopolies, they can tend towards monopolies. And so you have to regulate it in such a way that these things don't happen. And so capitalism effectively has to be managed to maintain its capitalistic tendencies sometimes, but in an effective and smart way. And the hard part is, well, it's very, very hard to do that and obtain the political will to maintain that. So if you leave it unrestrained, it becomes something that tends towards oligopolistic tendencies. And if you leave it, and where we point at the failures in this, and the failures of pricing, it's because there's an absence of competition or other elements. And then there has to be, in writing that framework, we have to be thoughtful and positional about, how do we make the government efficient, and where the government we need the government for, and where it's less successful. And then we also have to maintain regulation in a way that's broadly effective. And we don't have answers for healthcare expenses yet. We don't have answers for these things that are very challenging. These are very good points, by the way. I'm reading your comments. These are excellent work. So going back a little bit, good. We got some subtle discussions on socialism. Very good. Andrew says the average monthly electric bill in Austin is around 170. That's not bad. Jochen says Germany has had a social democratic party almost since the end of World War II, and they're fully committed to and supportive of democracy and freedom. Joseph says, what are the top 3 new businesses needed? For example, building inexpensive housing. Joseph O'Donnell, what an interesting question. What are the top 3 businesses that we need? So in the Bay Area, so fundamentally, so the question is, what would improve the quality of life? So yes, housing, you need just housing stock in general, like vastly more. And the way that housing stock looks need to be different. You need infrastructure to support that housing stock, would be 2. So I would say housing, I would say supportive infrastructure. And then thirdly, what would I say you need thirdly? You asked for 3 businesses that you need. So housing says, I think you need a governmental permitting system that's effective and efficient. Aaron says the MH economy is all we have left in growth, and they're cutting back. This summer, housing sales have tanked. We're all stuck waiting on tariffs to blast across industries. CapEx has fallen 50%. You're absolutely right. So that's true. So Aaron's usually the YOLO economy.
The YOLO economy. Yeah, I mean, it
Needed
doesn't
to
matter
be.
where the economy is, you're just going to continue spending. And so
That's
I have the economic release calendar ahead of me, and I was just looking at what else
yes.
expecting next month, right? So we'll get the JOLTS report on July 1st. We'll get the
It's going to be
employment
interesting.
situation
Yeah.
right before we go out for the holiday. And then July 9th is Liberation Day 2.0, if it happens, followed by the CPI and the producer price index the following week. And so, how does one even look at the next 3 weeks, I guess, even to
Mm.
just look at that? Because
Okay.
it's clearly, I think, coming up on a lot of uncertainty, and and a lot has happened since April when we saw the initial Liberation Day stuff go into effect. And so I feel like maybe not as much of a big deal is being made about it, given the taco trade, given the geopolitical tensions, and all the other stuff that's been going on coming out of
Mm.
pests and so forth. So, what's the economic view on this?
So you're right to say that we're over distracted, Albert, by everything else that's going on to understand fundamentally what's at stake. I'm
Yeah.
actually very interested in if we look at an aggregate, all of these figures, imagine you're stacking things together and saying which is heavier. And
Yeah.
there's more on one side of the general consensus of things that are negative for consumers, right? And so yes, these things exist, right? We know that wage garnishment for student loans, right? That's coming across the board. That's happening. That's a negative for consumers with student loans who haven't paid them. We're looking at a series of factors that increasing debt levels, higher interest rates, all these other things, mortgages, and an inability necessarily or home people who wish to sell their homes confronting the effect that perhaps their home isn't as worth as much as they thought it would. All of
Mm.
this is a negative spiral. So the weight of that's heavier than the good things in the market. And what are the good things in the market right now are mainly past looking, and the bad things are forward looking. And so I have this thing and I weigh this together. And so I'd say pay attention to JOLTS, pay attention to the household survey as well as the payroll survey that comes out in July. Both of those will be very interesting, and see if there's any deviations in this. And even beyond looking at the question of whether people have jobs or not, looking at the underemployment measures, looking at the number of the number of things that involve intentions of and sentiment indexes of businesses involving this as they start passing along some of this post-Liberation Day, tariffs onto people. And so all of this fundamentally, there's more bad news than good news for the economy, and it's going to be hard for us to navigate this without consequence. So that is the thing where it is there's more bad stuff than good stuff where it's trending.
All right,
So oh,
some other great questions coming in. Do you
oh
see
yeah.
be people starting to become entrepreneurs while upskilling and more likely to get contract jobs? Do you see people leaving tech to a more in-demand
Yeah.
job like healthcare? What
Yeah.
advice do you have for unemployed people?
So, Margot, that's a great question. And in particular, if you look at the question of start becoming entrepreneurs and upskilling, yes. Are you going to get contract jobs more? Sure. I mean, yes, I think experience in general makes you more smarter about everything. But I think you're going to see this mixture, right? You have companies who are now hesitant, so broader macro level, right? Companies confronting a complex environment, they're hesitant, but we've seen how they've been hesitant about hiring. They've even let go people who are experienced project managers in favor of people with less experience management. And so companies cost cut in different ways. Some more likely contract out, to your point, and looking likely to get contract jobs and other things. I see that as being opportunistic. I don't see that in aggregate driving an economy forward and saying, well, I can't get a full-time job, so I'll get a bunch of contract jobs. I think it is an intermediate. I think it's a transitory space that one can exist in and be successful in, but also one that I think we're going to see more of. Do I see people leaving tech to more in-demand jobs like healthcare? I think so, and I think that's not bad. My advice to job seekers is, in general, if you've got a myopic focus on one particular thing in industry, and yes, there's there's a compelling spirit, especially if you went to school for computer science, or you went to school for some element in programming, and you're at a level where you're surrounded by, you want to be in the best and do all these things well. Your skill set, even if it's not valued in a highly competitive sector in your particular area, is incredibly valuable outside of that sector in other areas that are apart from this. And so I would say my advice to job seekers is based upon this very observation that you make, is be expansive about what you think you can and can't do. Be thoughtful about this, because I've sat in many hiring committees, I've sat in other things as well, where an expertise that transcends different boundaries has been advantageous to hiring someone, especially someone who understands technical ability. I would say as well, one of the challenging parts as well, if you have an opportunity to work, manage people, do other things as well, do so. It builds your resume. You can always step back from that if that's not your thing. And it's nice to have that there, and that provides you more context. Upskilling in general, another way to say different forms of education, right? The way that we go about the skills that you acquire. So not necessarily the book education, but different aspects, skills, techniques, certifications, all that stuff. All that stuff helps, right? Because it puts you in a position where you're challenging yourself to reach some other new level of qualification. Be sure, though, what you're doing and spending time on is relevant, though, and don't waste your time, because your time is as valuable as anything else. And my advice to job seekers is remember that every hour that you spend is in fact valuable. Do it efficiently and do it well, and take pride in these things. It's worthwhile. John said, has AI made a significant attributable impact to corporate earnings? That is a fascinating question, John, and I don't have the data on that because we're not certain about what that means. So I would say in general, yes, probably, but maybe not, and that's difficult to say. So how would I measure that is the hard part. When we look at a question about even something as nuanced as a job, right? So I manage a team probably under me, I don't know, 40-ish people who at some point, at some level, report up to me in the ladder. And I am certain AI has improved their productivity. How I measure that productivity is highly subjective. And so I don't think we have the ability to measure that effectively, because one thing, my general critique about corporate America right now in general is there's an inability to, we lack a requisite skill set. It's one thing, and this is why we're struggling with that work from home thing. And you argue with this and say, well, work from home increases productivity. But if you go it fundamentally, if I'm a company owner and I'm looking at this, am I measuring productivity well? Am I actually doing this? Or do I just have a vibe that you should be in the office? And so AI has made an impact on work. How it's attributable to corporate earnings is tricky, given that corporate earnings has in general been more negatively skewed as of late. And that's due to lower expectations in the future, among other things. So that's actually interesting. As recently as 2 years ago, when the S&P 500 companies would release earnings, about 80% of companies beat the expectations of analysts. And that's since fallen quite a bit. So, and Joseph says, does it make sense to start a gold, dollar, Bitcoin exchange business? Where are you rolling up on that? That's interesting. Are you going to Embarcadero? Are you going to walk around with a cart and just, do these things? And you're like, hey, gold, and give me some Bitcoin, Bitcoins for dollars. We got these things. It'll be good. I always imagine just a flock of seagulls just surrounding for some reason. They want to, they love Bitcoin. I don't know. So that's a good question. So I would say the problem with that, which is not a bad idea, is that, there's always ideas. People exchange. A lot of people want gold and dollars and Bitcoin. Is
And
that
gold performed really well this year, hasn't it? Given the
it has, but you
uncertainty.
make money exchanging them
Yeah.
if you based on the margins that you get between them, right?
And if
And
you're
so
buying gold now, you're buying at the top, if I understand, right?
yeah,
So,
it's gold is very pricey right now. Absolutely right.
yeah.
And so to your point, Joseph, you'd have to you in the exchange, you'd make money on the different, you'd make money on the margins. And the problem is that bid ask spread between gold and dollars, for instance, or even dollars and Bitcoin. People it's a volume business. And so people can always provide a better deal and a better price for buyers and sellers if they handle a large volume. And so startup businesses are disadvantaged in that space. But if you can figure out a way to make it work, you should do it. And then Aaron says, we should understand that people should try to get a broad blend of skills. Chatbots, Excel. Oh, learning lean Kaizen. This is good. Basic customer management, all out there. LinkedIn books, YouTube, Substacks. Now, that's an interesting. Get people that make that happen. Aaron, make it happen. Write a book. It's a book about everything. Aaron De Los Reyes. Chili pepper harvesting techniques.
Chili harvesting.
I was listening. We have this. I was talking to one of our business owners who recently who runs a chili pepper farm. That's one of our. It's what we call it. It's like our Nvidia. And so we ran this down there, and he's explaining this to me. He's like, "Feel how hard it is to rip this off with your thumb and only your thumb." And I'm like, "Oh, this is challenging. I can't possibly conceive of this." He made me learn it the hard way, which is very funny, but it was good. So that's how I spend my summers now. I go into the chili pepper mines and That's what we do here in New Mexico. Here we have our economy, our entire economy is can fit inside of Redwood City. I know. I just
How can
Oh,
a
Vikram.
help to
Oh,
fix
Vikram, we got one.
immigration
How can
laws?
economists help to fix immigration laws that prevent house building? Ooh, we say a lot of things, but no one listens to us, Vikram. So that's our first problem. So the second part is we have to make policy that's cognizant. And that's an interesting question. So the issue with being any intellectual economist and finance person is the fact that we are by nature intellectual, and everything that we create is itself not a less applicable or complex because it's intellectual. And policy and intellectualism often don't vibe well. And so when we look at things like fixing immigration and laws that help prevent house building, good policy is informed by this, but policy that actually comes to effect has to be passable fundamentally. And so while I can describe an economic ideal in a situation, it's challenging me to write, it's more challenging for me, for instance, to write the policy that enforces that ideal because policy itself is inherently political and inherently resides on a consensus of the population that desire to that are being governed by said policy. And so there's always going to be that difference there. And so the key, if economists really want to be better at this, they have to talk like normal human beings. And that's at the end of the day something that we have to work on as a field, which we don't do well. Aaron says I'm
I
working
mean,
on
you
a
can do
couple
that kind
policy.
of stuff because you're writing books about like personal finance, but in a very easy to read mo mode, right? So I mean, I think and as I've mentioned to you many times before, and maybe the audience here feels the same, is that I think sitting through these webinars for the last 3 years makes things a lot easier to understand than sitting through Econ 101 in my undergraduate freshman class seems to be. So I mean, I don't know, maybe I was taught economics the wrong way. I have no idea.
No, that's so nice, Albert. I appreciate that. It's
No?
fine. You guys are too nice. Thank you for hanging out with me. I appreciate that. No, I don't take it for granted, and I know what it's like to sit on that side of a complex subject.
Yeah,
That
and that was what was that? I think my textbook was the ManQ textbook. So maybe
Yes, yeah,
hit up
Greg
your
Mankiw. That was I think my first textbook too in the day. Greg Mankiw, interesting guy. I used to
you gotta
read
call
his
up Greg
blog.
ManQ and tell him to simplify his thinking.
Every day I try. I don't think he responds to my emails either, in fact. So I'm just saying, does the best he can. But Greg
Why
Mankiw,
can't you come out with a textbook?
Greg Mankiw. I mean, these guys are, it's interesting. Don't ever meet your heroes. They're very interesting in person, but it's tricky. He's a complex guy. He was very interesting. He skewed kind of. He was more, economists have left wing and right wing. He's more of a little bit more on the right wing side, but he had some interesting. He was big on Pigovian taxation for a while. That's things like higher taxes for things like gas and things. Which, if you live anywhere in the country that isn't a city with public transportation, people are like, "Oh my God, why would you advocate for this?" And so it becomes tricky. And so he's countering that with being more detached, and that's interesting. But his fundamentals of economics book is solid for sure. So he's
Yeah.
got a good thing about this. Is there a survey of keywords listed on major jobs? A survey of keywords listed on major jobs. What an interesting question. I don't know, John. An interesting question. Yes, probably a survey of keywords. That's the type of article. I have to Google Scholar that. I bet you somebody's written a job keyword article at some point about this. Job boards. Like we can get the software that will it's easy to write the software. Well, not easy, but it's fine. It's doable. You can write software that combs through all the job boards and collects that data. So, that's interesting. Paul's advanced series in Romer's book. Oh, that's nice, Aaron. That's great. Solid as well. William Green writes a nice little handbook that's pretty good at the graduate level for finance, as well as oh gosh, I don't have it around here somewhere, but there are some good ones. People ask me, what should you read? There's Basic Economics is actually a pretty good book. I mean, some people, I would say read it as well. Read Piketty's Capital. Read a bunch of things from different economists with different viewpoints on things.
And how about podcasts? Are you a podcast consumer? of
Oh
economic?
man. Now that's a good question. Not as much as I should be. And that's the downside. So this is good. So I wish I could give you all good advice about this. I'm on a pod. That's funny. So this week I was on, so I get all these random interviews. So I do interviews for like PBS's Marketplace Radio and all that stuff. And they wanted me for this last week. I did an interview about explaining, they wanted it for their podcast for 5 to 12-year-old kids about, they wanted me to explain on the podcast how the national debt worked, which was very fun. I have an 11-year-old child. And so I'm like, James, my name's James. And I said, tell me a little bit about, let's see, how can I explain the national debt to you? And imagine, and I used like an allegory of a cookie jar. I really dug deep on that one, but involving that one, so I don't know how that's going to pass and how that's going to go. I used a bunch of series of things, and if they ask me to explain other things, macroeconomic pricing and a Taylor series, but in the form of something kids can understand, that's gonna be rough. It's gonna go tough.
I mean,
But no,
cookie
yeah.
jar is perfect, right? Because, the supply and demand of cookies in the house that, when it's close to dinner time, the price of the cookie goes up because your kid wants to.
Oh, nice. So you're actually looking at more price. That's pretty good. You're looking at very, pricing mechanisms. That's pretty good, actually.
Yeah. And
Stochastic pricing with
and what like
cooking.
the dead weight loss of eating the cookie.
Dead weight
You
loss.
no longer have an appetite. And
Right.
the Pigouvian tax would be that, you trade off broccoli for healthy broccoli for sugar. Right? So
That's great. That's why I wondered why my son was so neurotic, and I understand now. It's like apple tree. Here's where we
yeah.
are. Here's where we're going. Do the best you can.
All
The more
right.
you
We
push
are an
towards
hour and a
fitness,
half
the
in.
comes. Yeah.
Um, what is your prediction? Final thought. What is your prediction for it's funny, right? Because I think since this time last year, I've been telling you, oh, we're gonna see the first negative jobs report in, 3 months. And it still hasn't happened. So they're either cooking the books over there at the Bureau of Labor Statistics,
No, the
or really
BLS
making that
people,
better.
I have full faith in their integrity, Albert. They're doing wonderful things. But to your point, though, I mean, this is not respectfully. This is not sunshine rainbow job market. We're in a good position for sure, in the sense that most people have jobs, even though they don't like them. But in
Yeah.
the sense of these things in general, we're in a relatively good position. I think right now, though, I am also impressed at the resilience of the economy. So when you
I
ask the
am too.
question, will we
Wow.
see a negative jobs report this year? I will go on record and say, yes, I think by December we may see one negative, and I don't know whether it will be repeated or not.
Oh, wow.
But if I'm wrong, I'll own it, and you can call me out on it. That's what I can say because I've been too much of a dilly dallyer on making firm predictions on this.
And
Melanie
I've been
says,
there too. I mean, I don't know. Like,
yes. Melanie's got a good point though. Maybe they were all doged at BLS. Maybe we're getting old data. Maybe it's just an intern who's just like, I gotta write this now. There are all these things. I know.
yeah.
Nobody
So
gets rid of the
all
economists.
possibilities for sure.
The
But
problem is, yeah. So the question is, we would notice. So if they were really cooking the books, I think we would notice it because variable A wouldn't look like variable B. So something would be really screwy. And right now we're telling the same kind of story. So that's where we are, as variable as the data is.
yeah, because I mean, I still come here
Wow.
to look for all of this stuff, right? And I mean, the U6 is coming down at least. It's 7.8% up from 8% in February, so that's nice. Um, so yeah, well. In any case, if there are no other final questions, I've now dropped the link to our next month's webinar in the chat here, so feel free to sign up for that. It is going to be July 24th, 2025, Thursday, well after, we'll see what Liberation Day 2.0 and how its impacts go through the market, along with inflation reports and the employment reports. And I don't know, is the Fed also meeting in July as well?
Oh God, I knew that question was coming. So the Fed, I think they're meeting on the end of July. I think it's like, here it is.
Looking at the meeting.
Uh, 29th to 30th is when they meet.
Okay,
Yeah.
so they will be meeting
End of the
afterward.
month. Yeah. And then
I,
in September, October, and December.
we only
Keep it
have
in
so
your
many more
calendars.
of these meetings for them to lower rates.
Even then, we're talking quarter point tops, and it's going to be based on it would be random if it was. I think they have every incentive to hold, and that's the real downside is we all were jazzed about hoping for those lower mortgage rates or something, and right now it's challenging. Even though they don't affect mortgage rates directly, the 10-year bond yield follows mortgage rates. I want to be sure so nobody's like Reilly said this is no. The discount rate is one rate, but it is connected to a large amount of rates in the system. Aaron.
Well, as we keep going, we'll just keep building skills. We'll come back and we'll see you all soon. This is
Great.
recorded. You'll see it on YouTube in a little bit. And we're going to, we look forward to seeing any other data that comes out. And as always, ask your questions. I will look at them this time, and we'll see you all soon. Have a wonderful rest of your June. Enjoy some of your summer, and we'll see you here in a month. See you later, everybody.
See you guys later. Thanks for everybody. Thanks, Albert. Thank
Bye.
you guys. Thank you, Aaron. Thanks, Melanie.